So number 3, know your risk so you know what to expect. Problem for a lot of investors is they see that something just made 30% or 20% or 25%. They say, give me some of that, and they're hopping on this roller coaster right here. And they have no idea. And they're hopping on it at the peak, and then it hits that downturn, right? We want to know our risk measurements, our standard deviations, and our betas in our portfolios, and I'm going to go over that with you right now. So we know which kind of volatility is in our portfolio. And it's perfectly fine to be in the low volatility portfolio if that's the one that you can stay disciplined. There's nothing wrong with that, but you have to know which one you're on. The problem is that most investors hop on the big one. So the higher the standard deviation number, the higher the volatility in the portfolio. The higher the beta number, the higher the risk in the portfolio. And again, Scott and I subscribe to this, software to help this figure us out for our clients and for us. What's the risk in the portfolio? Know your risk measurements and don't be tempted to take on more risk than you can handle. Because the worst thing you can do is get on that aggressive roller coaster. It has its 20% decline and you hop off. You're going to cause yourself a tremendous amount of money. We know that stocks are more volatile than bonds, and bonds are more volatile than cash. So we have to find out the right mix for you, for your particular individual circumstances. To reduce turbulence and volatility, we diversify using short-term fixed income and rebalance on market highs and lows. Here's what that looks like. This is 100% stocks. Look at the volatility in that, though. But look at the performance. Everybody wants this, after it happens. You have 75% stocks, 50% stocks, and 25% stocks. So very low volatility, and that's okay. Most of these can get decent returns over time. So in your folder, you'll be able to see this. We'll give you the current standard deviation and beta measurements. But the important thing to know is a beta of 1 equals the risk of the Standard & Poor's 500, which is 500 large American stocks, 100% stocks. Anything greater than 1 has higher risk. Anything less than 1 has lower risk. And there are lots of portfolios and mutual funds that have a lot more risk and a lot greater than 1 out there. You have to be very careful. So you can see here, if you're in 35% stocks, you have about 1/3 of the risk. So it makes sense, right? It makes sense. And if you're in 60% stocks, you have about 60% of the risk. Same thing with the volatility. The higher the number, the higher the volatility in the portfolio. So you can see here, if you have a 35-65 allocation, you have about 1/3 of the volatility of a 100% stock portfolio. Same thing with the 50-50 allocation, about half the volatility, roughly. So the reason that that's important is when we're going through these downturns is when people really pay attention, is when they say, oh, the stock market's down 20%. And you'll say, okay, I remember Scott and John taught me that I have a 50-50 balanced allocation. I remember them going, I don't know my exact numbers, but I remember them saying that should be about half the volatility and half the risk. So I'm probably not going to be down 20%. And then you can verify that pretty easily. And then the next page will have definitions. You can read about that later. Know your risk so you know what to expect. And any one given year, anything can happen, from negative to positive. Okay? When you should start measuring performance is over longer periods of time. Don't be surprised if it happens at any point in time. If you know your risk measurements, you will know what to expect and won't be caught off guard when downside volatility occurs.